Crypto taxes explained. What the IRS wants you to know. The IRS just sent out a warning to crypto traders. And they're hunting for people who owe thousands in taxes they don't even know about. I'm talking about people who made $500 on Bitcoin and think it doesn't matter. People who traded altcoins on Robinhood without tracking a single transaction. People who got crushed by the 2022 crypto winter and have no idea they can claim losses. The penalties for getting this wrong? Up to 75% of what you owe. Plus interest. Plus criminal charges in extreme cases. The good news? By the end of this video, you'll understand exactly what the IRS wants, how to calculate what you actually owe, and the one mistake that's costing crypto traders thousands every year. Let's go. Part 1. Why the IRS cares about your crypto. First, here's what most people get wrong. Crypto isn't special to the IRS. They don't care if you're trading on Coinbase, Kraken, or your cousin's Discord. Crypto is property in the eyes of the law. Same as stocks. Same as real estate. Same as your car. Every single transaction is a taxable event. When you buy Bitcoin for $10,000 and sell it for $15,000 6 months later, that's $5,000 in taxable gains. The IRS wants a piece of that. When you trade Ethereum for Dogecoin, that's a sale. The moment you swap one coin for another, you've triggered a taxable event. Most people have no idea. They think they only owe taxes when they cash out to US dollars. Wrong. The IRS disagrees. Here's what actually happens. Coinbase tracks everything and sends reports to the IRS. Same with Kraken, Gemini, and basically every legitimate exchange. If you made over $600 in transactions last year, the exchange files forms with the government. They're watching. They know. And if your tax return doesn't match what they reported, you're getting flagged. The penalties are brutal. We're talking about a 75% accuracy related penalty if you underreport your income by more than 25%. That's on top of the taxes you owe. Plus interest if the IRS thinks you did this intentionally. Criminal charges. Federal crimes. Prison time in extreme cases. Nobody's going to jail over missing a $50 crypto gain. But the point is this. The IRS is serious. They've hired thousands of new agents specifically to go after crypto. Part 2. How to calculate what you owe. Let's use a real example. Say you bought 0.5 Bitcoin on Robinhood in January for $19,000. In June, you sold it for $22,000. That's a $3,000 gain. That's a taxable event. Whether you're holding that money or spent it on a Tesla, you owe taxes on those $3,000. Your tax rate depends on how long you held it. If you held it less than a year, it's short-term capital gains. That gets taxed at your ordinary income rate. If you're making $70,000 a year, you're probably in the 22% tax bracket. You'd owe about $660 on that $3,000 gain. If you held it longer than a year, it's long-term capital gains. Much better. You're looking at 0%, 15%, or 20% depending on your income. Same $3,000 gain? Only $450 owed at the 15% rate. Here's where it gets complicated and where 90% of crypto traders mess up. You need to track every single transaction with the cost basis. Cost basis is what you paid for it. When you sold that 0.5 Bitcoin, you need to know exactly what you paid. Not just the average, the exact amount. Because the IRS allows you to choose how you calculate gains. First in, first out. Last in, first out. Highest cost first if you have one Bitcoin you bought at $30,000, one at $40,000, and one at $50,000. And you sell one. Which one did you sell? Most people don't know. The IRS wants documentation. This is why most crypto traders owe more than they think. They can't prove their cost basis. They can't prove when they bought. They lose receipts. Exchange accounts get deleted. The IRS assumes the worst. They calculate your gains with worst case numbers. Part 3. The one mistake costing you thousands. Not tracking losses. If you lost money on crypto, you can deduct it. You can deduct up to $3,000 per year against your ordinary income. That's free money you're leaving on the table. If you bought Dogecoin at 0.30 cents and it dropped to 0.15 cents, you have a loss. Claim it. If you had 10,000 in losses last year but also 5,000 in gains, net $3,000 loss. You can deduct $3,000 against your salary. That could save you $600 to $900 in taxes depending on your bracket. Most traders don't claim losses because they don't track them. They don't remember. They don't want to face it. That's a mistake. What you do now: download your transaction history from every exchange you've ever used. Use software like CoinTracker or Coinly to calculate your gains and losses automatically. These tools pull directly from exchanges and do the math for you. File accurately. If you owe back taxes, file an amended return. The penalties are less harsh if you file before the IRS comes to you. This is the difference between paying what you actually owe and getting hammered with penalties you didn't expect. If this video saved you from an IRS headache, subscribe. New personal finance videos every single week. Thanks for watching.